lows in over 3 decades. A surge in COVID cases in China clouded the short-term demand outlook, and a hawkish Federal Reserve that wants to push rates higher for longer in order to squash inflation increases the risk of tipping the economy into recession. Moreover, grim warnings by the IMF for a rough year hurt energy traders' sentiment, since the fund forecasts recession across one-third of the global economy. The unscheduled shutdown of a US pipeline late Wednesday aided at the rebound of WTI prices in today's session, snapping a 2-day losing streak. In this report, we aim to shed light on the catalyst driving WTI's price, assess its future outlook, and conclude with a technical analysis. On New Year's Day, the head of the International Monetary Fund, Kristalina Georgieva, delivered a grim global outlook for 2023. The fund's managing director stated that 2023 it is to be tougher than the year we leave behind, and foresees that one-third of the countries of the global economy will fall victim to recessions. The rationale behind the gloomy outlook is predicated upon the simultaneous slowdown of economic activity from the world's 3 largest powerhouses, namely the US, China, and Europe, and is being exacerbated by persistent inflationary pressures, high interest rates, the ongoing war in Ukraine, and the uncertainty surrounding China's exit from COVID-0 policy. The IMF placed particular emphasis on China's growth projections and warned that for the next couple of months it will be tough for China, and the impact on Chinese growth will be negative, and highlighted that surging infection cases across the country are expected to hurt the economy, impacting growth on the domestic as well as on the international level. The warnings caused energy traders to reconsider their bullish stance against the long-awaited relaxation of the country's zero-COVID policy, which was expected to boost crude oil demand from the second-largest oil-consuming country. Earlier today, oil prices found support after 2 sessions' heavy losses, as traders quickly assessed a report issued by Colonial Pipeline, a pipeline operated in the US, declared that its Line 3 has been shut down for maintenance and it will be inoperable for the next few days. The unscheduled maintenance raised optimism for a short-term rally in oil prices, and oil traders will be monitoring closely any further developments in regards to the restart of the pipeline. The operator expects the pipeline to go online during the weekend. Yesterday, the weekly API crude oil inventories figure pointed to buildup of minus 3.3 million barrels in stocks, signaling a slack in demand for oil, reflecting the downward trajectory crude prices had this week. Later today, the EIA weekly crude oil inventories are expected to record a buildup of 1.15 million barrels according to estimates, higher than the 0.7 million recorded last week. Should the actual figure meet the expectation, we may see the oil prices weaken, pairing some of the intraday gains recorded today. Lastly, we would note that last Friday, the Baker Hughes oil rig counted showed that the number of active oil rigs in the US has dropped by a count of 1, reaching a total of 621. Thank you for watching.